Can everyone see the screen? Hello? Guys, you can unmute yourself if you want to talk, or if you're not ready to talk, you can just, what's this? You can type in the chat if you can't see anything. So, can everyone see the screen? You can also zoom in from your screen if you can't see properly on my side. Okay, I'm just gonna assume that you guys can see, and then I'll continue. Okay, so today we're going over question 2. So with question 2, it's company financial statements. Company financial statements, and we are shown here that we need for 2.1 to complete the statement of comprehensive income for of Kiza Motors Limited for the year ending 28th February 2022. And so this is what they've shown us a format. They've already written down some of the amounts already, and then others will still need to work through. So we'll need to go through the information that is given, and we'll also need to go through the adjustments as well. So let's go through our paper. So information relating to Kiza Motors Limited. Kiza Motors Limited is a South African listed company that trades in small to medium-sized electrical motors that are used in commercial products. They have an authorized share capital of 6 billion ordinary share, and they add a standard markup of 200% on the cost of all goods. The latest financial year ended on the 28th of February 2023. And then for number 1, they're saying extracted balances from the financial statements on 28th February 2022. So as you can see, we are focusing on the year 2023. So that means these end of balances, end year balances from 2022 are called our opening balances. Okay, then we continue. The extracted balances and totals from the pre-adjustment to our balance for the year ended 28th February 2023. So these are the balances for our accounts before the adjustments. And then if we go on to the next page, that is where they show us the adjustments. So now looking at the adjustments, the first part, they're telling us additional information relating to shares and dividends for the year ended 28th February 2020. Now, what are we doing? The statement of comprehensive income, and that has nothing to do with our shares and dividends. So for now, we will ignore that information because it is not relevant to the question that we are answering now. It doesn't mean it's not important for the whole question, but not for the statement of comprehensive income. Okay, then let's continue. The second part, they said additional information and adjustments that still need to be taken into account. Now, these are the adjustments that we need to go through. Okay, so let's start with the first adjustment. They said here a customer prepaid the service fee of 2,800 for the service to these motors that will be carried out in March 2023. Now, this information is so service fee. We need to look at our fee income. That's the account that will be affected by this. And how will it be affected by this? So when a customer pays in advance, that's what they mean by prepaid. They've paid in advance. This These services are not going to be done in the current year. going to be done next year in March 2023, meaning they are not part of this year's income. So if they're not part of this year's income, what do? We need to subtract that from our fee income. Does that make sense? Guys, you can always stop me and ask questions. It's very important that you interact so that I'm not just talking to myself. Maybe you don't understand something. You can type if you don't feel comfortable speaking. Okay. Is everyone good? Okay. I'm gonna carry on. So we're gonna minus the 2,800 from our fee income because this is for next year. It's not part of this year's fee income, so we need to remove it. Minus 2,800. Okay. Then we carry on. We are told that it was discovered that the water and electricity account for February 7,200 was never paid. So this is for February, meaning it's part of the current year. So can anyone just type in the chat, what are we going to do with the 7,200? What do you think we're going to do? Do we add it? Do we subtract it from our water and electricity? Okay, so for the water and electricity, we're supposed to add that amount to our water and electricity because it's for February, even if it has not been paid, because it's an expense for the current year, that means we need to include it in the current year. So we add, what is it? 7,200 to our water and electricity. Let's carry on. The company donated goods to a local charity. This meant that a gross profit of 12,400 was not made as the goods were not sold. Okay. Some of you weren't here in yesterday's class, but I did explain that with cost of goods sold and our sales, we are recording the actual sales transactions that took place. So if they did not take place, then you cannot record them as part of your cost of sales or sales. So this is why they say the gross profit of 12,400 was not made as the goods was not sold. Now, they didn't give us the goods we donated, they didn't tell us how much they cost. They just told us what the gross profit we would have made from those goods would have been. Now, from our information, our background information, they gave us something important information of the markup. They said the standard markup is 200%. Now, the markup on the cost, that percentage, that 200% represents your gross profit. So your gross profit is at 200%. Now, your cost is always 100% and your sales is always the cost plus markup, which is 100 plus 200 in this case. But now, what are we doing? We're doing the donations. We're calculating for our donations. So, how do we do that calculation? What you have to do there is to take the gross profit, which is 12,400. That's our gross profit. Remember, I said gross profit is 200% and our cost is 100%. Now, what's the next step? With your fraction, you need to multiply this 12,400. At the top, you put the percentage that you are looking for. And we are looking for cost, which is 100%. And at the bottom, you put the percentage of the amount you have, which is your gross profit, meaning its markup percentage, which is 200%. So you'll take 12,400 times 100, which is what we're looking for, divide by 200, which is what we have, our markup for gross profit, and that will give you the, what's this? That will give you the cost of the goods that we donated. Okay. Questions? Does anyone want me to repeat that? Octavia, you've been quiet. Are you good?
Hello, yes, I'm good, but I'm still trying to find my feed on the gross profit. I'm still busy with it. So I want to see because I've just calculated 12,400 times 100 over 200. So I got 6,200 right?
Yes, that's correct. Okay, so yes, you will get 6,200, which will give you your cost because that's what we were looking for. Gross profit we were given at 12,400. Now, you made a donation, meaning you didn't sell these goods, so you're gonna record the donation at the cost price. Now, where will the donation go? The expense, because you didn't sell these goods. The way you gave them up. So this will not be part of your sales and cost of sales. It will go under operating expenses as donations, and that amount will be the what's this? The 6,200. Okay, let's carry on. Now, for the next transaction, they're telling us that an amount of 32,000 for an advert was amount of 32,000 for an advert that was placed in the local newspaper in February has not yet been paid. Right. So they're telling us we have not paid the 32,000, and we made this advertising cost was incurred in February. Again, just like the water and electricity, you need to include that as part of this year. So go to your advertising and add 32,000. Then let's continue. The newspaper had purchased a parking garage door motto for 7,500. The sale has not been recorded as it was agreed that Mkhize Motors Limited could deduct this amount from the amount owing for the advert. Okay, now let's visualize what has happened here. There's us, the business, and then there's the newspaper company. We, from the newspaper company, they placed an advert for us, and that cost us 27,000 that we have not, sorry, 32,000 that we have not paid for yet. So we owe them that much. And then we gave them a door motto for 7,500. We sold that to them. And they also haven't paid that. So now what they're saying here is that since we both owe each other, we just said we need to offset the amount, meaning whoever owes more will just pay the balance. I won't, you won't, as a business won't pay for the 32,000. What the newspaper business is saying is that you owe me 32,000, I owe you 7,500. So let's do it like this. I won't pay you the 7,500. Instead, just decrease the amount that I owe you. Does that make sense? But that does not mean a sale didn't happen. So we still need to record that a sale did happen. This is the payment structure does not affect the fact that the payment structure won't change the fact that a sale has happened. So we need to record that a sale has happened, whether they'll be paying it in this way or any other way. Does that make sense? So we go to our sales and we add the 7,500 because the sale has happened. Okay. Now, every time a sale happens, what else gets affected? Your cost of sales because you sold goods and now your inventory has decreased. So we need to include that part in our cost of sales. So we have the selling price, but we don't have the cost. So another formula is coming up now. When you have your sales and you don't have the cost. Remember, I said the percentage for your sales is equal to your cost, which is 100% if you're doing markup on cost. So your cost percentage is 100, then your sales is equal to that 100 plus the markup. And in this case, we were told that our markup is 200. So that means our sales will be 200 plus 100. So we have the selling price of 7,500. So we write that down and then we multiply by what we're looking for. We're looking up for the cost of the goods that were sold. So we are going to multiply by 100 and then we're going to divide by 100 plus 200, which is your cost plus your markup. Everyone get that formula? Okay. Any questions? Okay, so that should give you 2,500, and then you'll be adding that to your cost of sales. Plus, I don't know why it's writing this. Plus 2,500 in your cost of sales. Okay, now that's done. Then we continue consumable stores. Now, consumable stores, we are told that the bookkeeper forgot to reverse the transaction for the consumable stores on hand on the 1st of March 2022, meaning at the beginning of the year. So this is our consumable stores here. Okay. So we're starting off with consumable stores of 1,250. That's what they mean by they were not reversed, meaning these consumable stores right now, at the opening, at the beginning of the year, they're recorded as an asset. Excuse me, but once the year starts, we're gonna start using like our expense, our consumable stores expense is gonna start from that opening balance. So we need to include that 1,250 as part of our consumable stores expense. Then we need to see what else happened. They're telling us that 2,250 worth of consumable stores were ordered and recorded. However, it has not yet been delivered as the supplier is still waiting for certain items. So we bought consumable stores, but they have not been delivered to us yet. Before I continue with that, also need to see here what were the consumable stores that were recorded, which is 45,700. That's how much we had bought the current year. So we need to add that to our expense as well. That's 45,700. Then the 2,250, what they're telling us is that you have paid for them, but you haven't received them. So they're not with you at the moment. So that means you can't count them as part of your expenditure because you can't use something that is not there with you. So we need to minus the 2,250 from our calculation. Then the next part says the annual stock take indicated that the following was on hand on the 28th of February 2023, consumable stores 1,960. Now, if they're telling us that from all the consumable stores we had bought, only 1,960 is left, that means we also need to subtract that 1,960 from our consumable stores expense because we didn't use it. So each time they give you consumable stores at hand, always subtract that from your expenses because it was not used. Your expense is something that you have used, you have consumed. So you haven't consumed those consumable stores. So now you need to take them over to your assets. Okay, that was a lot, but did everyone get that? Why we are minusing our closing stock of consumable stores. Okay, so minus 1,960. So then our consumable stores will be 1,250 plus 45,700 minus 2,250 minus 1,960, and that should give you 42,740. Those are your consumable stores. 42,740. Okay. Then they gave us another stock take. They told us that the trading stock is at 672,000. Now, let's go and look at our trial balance. What is our trading stock? Here, we're given trading stock of 695,000. But before we even look at the trading stock at the end of the year, if you look in our previous adjustments, there are two previous adjustments that affect stock. Remember, we donated goods, and those goods were worth 6,200. So what happened to that? It decreased our trading stock. So we need to minus 6,200. What else happened? We made a sale to the newspaper place, but we didn't record that sale. And the cost of those goods was 2,500. So we need to minus that as well because we no longer have those goods we no longer have those goods with us. Does that make sense? So we're starting off with 695,000. Starting off with 695,000. Then we need to minus the 6,200. Then we minus the 2,500. Then that will be what our trading stock is according to our books. So that'll be 695,000 minus 6,200 minus 2,500, which will give us 683,000, 686,000, sorry, 686,300. So according to the books, after those adjustments, this is how much stock we have. Then they made a physical stock count, meaning they went and counted the stock. And according to that, it's saying that we only have 672,000 in our trading stock. So that means in the books, we have more than what we actually have. And we call that a trading stock deficit. And to calculate that amount, you take the book value, which is 686,300, minus the physical stock take, what you actually have, which is 672,000. And that will give you a trading stock deficit of 14,300. Guys, you can stop me at any time. You can ask me to repeat at any time. But did everyone get our trading stock deficit calculation? Want me to repeat something? Either open your mic and tell me or type in the chat. I will repeat. Okay, I'm going to assume everyone is caught up. So then you go and record your trading stock deficit where? In your operating expenses. Trading stock deficit, and it's 14,300. Okay. Then let's look at our next adjustment. Depreciation on equipment is calculated at 20% per annum using the straight line method. Okay, so let's look at our equipment. So we've been given the opening balance of equipment. It's 1,160,000. They didn't tell us anything about what's this? They didn't tell us anything about new equipment being purchased or anything, but what they did give us was the accumulated depreciation as 935,000. Now, as you can see, our accumulated depreciation is really close to our cost of our equipment. So what you need to look out for is that it could happen that your depreciation for the year is going to be more than what the carrying value is. So you can't allow that. So let's test that. Let's check. So we have 1,160,000. Calculate our carrying value. So cost minus accumulated depreciation. We have 1,160,000. And then we subtract 935,000. Okay. And that will give you 225,000. Then let's calculate what our depreciation for the year is supposed to be. We take 1,160,000, excuse me, multiply that by 20%, and that will give us 232,000. So as you can see here, what do we see? Our depreciation is more than the value of our good. So it can't be. Our depreciation is always limited to the value that's left over. And you actually can't depreciate to even zero. You need to depreciate to one. So that means our depreciation then will be 224,999. Does that make sense to everyone? If you want me to repeat something, you need to say. Okay. Okay. Sorry about that. Okay. Let's just wait for this to load. Okay, so our depreciation is 249,000. Okay. No questions? We put that in depreciation. Depreciation 224,999. Okay, so now we're about to continue. What's the next?
Just a bit.
Hello?
With this depreciation, did you calculate it all?
Sorry?
With the depreciation, did you
Yes,
calculate it or raise it?
I
I
did
couldn't
calculate
get
it. Did I get cut off?
yeah, I couldn't get it there. It's just one.
Oh, okay.
Was it on the diminishing or on the
It
raise
was on the
one?
straight line method.
Okay.
Because it's showing it was on the straight line method. Do you want me to repeat the calculation how we got it?
Please, please, please.
Okay, no problem. So let's do that again. Our depreciation on equipment, we're told it's a 20% per annum using the straight line method. So we can see that straight line method. And then let's look at our equipment. We're given the equipment, it's 1,160,000, and then we are told the accumulated depreciation is 935,000. Now, the 935,000 is not relevant for the straight line method, but it's relevant for this particular question because, as you can see, it's really close, right, to what our it's really close to what our it's really close to what's this? It's really close to what our cost is. That's why it's important in this case. So that's why then we need to this. That's why then we need to first check do we what our carrying value is and how do you get the carrying value? Cost minus accumulated depreciation, and that gave us the 225,000. Then we calculated our depreciation for the year, which is cost times 20%, which gave us 232,000. Now, as you can see, we can't depreciate more than what the leftover value is. And we need to at least
This
stop at 1 rand.
90. Okay.
Sorry?
Yeah, I
Okay.
get you now because like I was lost with this 93,500. Where
Yes.
did you got it on the equipment on depreciation? Yeah,
Yes, the
accumulated
accumulated
depreciation on is 93,500. And
yes.
then, oh, okay, now I get it. Thank you.
Okay. So that's what we needed to do in this case because of that. So now that we have done that, where was I? Okay. So now that we have done that, then we needed to we limit our depreciation to what the value is. But still, we also need to make sure we are left with 1 rand if we are fully deep. We can't fully depreciate to zero. We can fully depreciate up until 1 rand. So that's why the 225,000 we minus 1 rand to get 224,999. And that's our depreciation on equipment. Okay. No, there was then we continue the next adjustment. So for the next adjustment, they're telling us that what's this? It was agreed that rent would only be increased by 5%, right? By 5% on the 1st of November 2022. If the tenant agreed to pay a 9,000 deposit, the deposit was received but not recorded. The rent for February is still owed by the tenant. Okay, so a couple of things here is the deposit. Now, the deposit that is not part of the rent income. The deposit, we would have it as, what's this? The deposit is like assurance that, okay, if they happen to leave early, let's say they leave before paying us, then we can just use the deposit or whatever other reason why they have. Maybe someone damages the property, they use the deposit to fix. So the deposit is not part of our rent income. So now what they told us here is that our rent has increased by 5% on 1st November 2022, right? And then they also told us that the rent for February is still owed by the tenant, meaning the rent amount that has been given here in our, what's this, in our statement of comprehensive income, the 89,200, that is only for 11 months, and that rent is not the same for the full year. There was an increase there. So what is always important in this type of question is for you to draw a timeline. Okay, I'm just gonna draw one here. So this is our little timeline. So there, what you do is you start with the beginning of the year, which is March, 1st of March, 2022. And then you write down the end of the year, which is the 28th of February, 2023. Yes. So you start with that. Then the next part to this question is for you to write down when did the increase happen. So the increase happened on the 5th of November, on the 1st of November, sorry, on the 1st of November 2022, right? And we only received rent up until the 31st of March, 31st of January, sorry. We didn't receive February's rent. So let's now label this. We received rent before the increase for this many months. So from 1st of March up until the 1st of November. So you count the 1st of March, but you don't count the 1st of November because the increase happened with was part of November's rent. So you count March, April, May, June, July, August, September, October, which is 8 months. So you received 8 months rent without the increase. Then from November up until what's this? Up until 31st January, there was a 5% increase. So that was for how many months? November, December, January. So that was 3 months of rent with the increase. Okay. Before I continue, does everyone have me up until that point? Then let me continue.
To be
Now,
honest with you, this always confuses me. Now and again, I don't even understand it. Like it keeps on like leaving me behind. But
okay,
let me just try.
but the timeline I've drawn, do you understand up until that point?
Yes, I understand with the timeline.
Okay, so always start with your timeline. I believe if you put in a timeline, it does help. Now, let's go back. Now, you need, this is math. It's math. I don't want to lie. It's math with your algebra. But now, you were told for the 11 months, the total rent that you received is 89,200. There, they gave it to us, our statement of comprehensive income. So this 8 months plus the 3 months that have a 5% increase, those are equal to the 89,200. So 8 months of rent plus what's this? It's 3 months of rent with a 5%. What's this? With the 5%. 3 months of rent with a 5%. What's this? Increase. So that would be 3 months times the 1.05. Now, how do we get the 0.5? The 8 months is at 100%, which means if it's 100%, then 100%, that's the full amount. That means one, like 1M. But for the 5% now, that is 1 plus the 5%, which is 1 plus 0.5. If we're putting them in whole numbers and decimals instead of using the percentages. Now, does everyone get me until that part? So 8 months, that was at 100%, so it's just going to be 8M. Plus 3 of those months were at 105%. That's why we have 1,05. Is everyone with me? So then that we were told gives you a total of 89,200 when you add up all that rent. Now, again, like I said, bit of math. So you have 8M this side, and then you're going to say 3M times the 1,05. So it's just going to be 3 times 1,05 in your calculator, and that should give you 3,15. 3,15M, which is equal to 89,200. Then now you can add these two because 8M plus 3.15M, they're the same, right? So that would be 11.15M equals to the 89,200. Now, we are looking for M, and M represents your rent before the increase. So what do? We need to get rid of the 11.15. So what do? We divide by both sides because at this side it is multiplying. So we'll say 11.15M divided by 11.15, and then we also divide by 11.15 this side. And then M will be equal to 89,200 divided by 11.15, and that gives you rent of 8,000, meaning rent was 8,000 before the increase. Now, before I continue, did everyone get that? Okay, Tavia, made sense this time?
Yes,
We're not done.
I'm following. I'm following well.
Okay, so we're not done with the calculation. That is rent before the increase. February is here, meaning this is after the increase. That's the rent that's missing. So we need to take that 8,000, multiply that by 105% or 1,05, and that will give us rent after the increase. So 8,000 times 1.05 will give you rent of 8,400, which is your rent after the increase. So that means that's the rent income you need to add. That's the month you need to add to your rent income because it was not included. We only have rent for what's this 11 months included. So we need to add that 12th month as well. Okay. Any questions? Okay. Did everyone get that? Sorry. Question, Donna. Okay. What's your question?
I was asking if after finding the 64 the total amount which was the 8,000, can I also just take the 8,000 multiplied by 8 months, find the 64,000 minus the 89,200 from it, and then the 25,200 I divided by 3 because of the 3 months.
Yes, you can also do that. That's another way you can find your rent after the increase.
Okay,
Yeah.
thank you.
Yeah, that's a smart way
Sorry,
as well.
teacher. Sorry. Can you just repeat that again? I want to get that.
Okay.
I feel like it's way
What she's
better for me
saying
because I've
is,
never done math.
okay, so what she's saying is you still have your timeline. You know that rent before, okay, so you found that rent before is 8,000, right? Before the increase. So now what she's saying to get the 8,400, what if you take 8 times 8,000 because that's for the, what's this? The 8 months. So you say 8 times 8,000 and that gives you, was it 64,000?
Sorry, let me just
Yes.
one check. Correct. Fine.
Yes, you get 64,000. Once you have the
64,000.
64,000, you minus that from the 89,200.
89,200. So where is it?
25,200.
25,200.
89,200. Where is it from?
We got it from here, our statement of
From
comprehensive
our,
income.
yes.
That's the rent for the 11 months. So you take the 25,200 and you divide that by 3 months, and it should still give you the
8,400.
8,400, which is your rent after the increase.
Okay, 25. And then this 25 200 I multiply by 3 months,
You
but it's
divide
still
by
owing.
3.
I
You
divide it
divide
by,
by 3.
oh, I
Yes,
think this
because
is
it
why
represents the
normally,
other 3 months that we paid. Because the 89,200,
and then
remember,
we
it's made up of 8 months and 3 months after the increase,
will give me 8,400.
which is your rent after the increase. Then once you have the 8,400, you can just go and add it to your rent income because it's that 13th month that's
Oh,
missing.
what? Now I get it. Thank you so much, Lisa.
So either you multiply by the 105%, the 8,000 to get the rent after the increase, or you do this. Either way works, whatever you feel comfortable with. That's going to get you to the answer. Where were we? Okay, so we're done now with the rent question. Go over to the next page. Okay, they're saying the bank statement for February was received. It indicated the following had not been recorded by the business. So we haven't recorded this information yet. Bank charges of 390. So let's see. You just add those because they were not recorded. So now you're just recording them by adding them, right? Plus 390. And then the next part says interest on the credit balance of 450. Now, what they mean by credit balance, what they're telling you about credit balance to the bank, when you have once you have a credit balance, that means it's favorable. So this is the information you would have learned this when you were doing reconciliation. So it's very important that you don't forget the information you learned from the other topics. But yes, if you have a credit balance at your bank, it's a good thing. That means you have money. So that's an asset. So if you have money, then that means that the interest on credit balance is interest income. Does that make sense? Because you've earned that interest. Interest on asset is interest income. So then that means we need to go over to our interest income, which is currently at 6,400. Remember, they told us that this 450 was not recorded. So now we need to record it. Plus 450. Okay. Then we continue. A debtor who had previously been written off as bad returned to pay 7,000 that had been written off via EFT. Now, they didn't say this person was written off in the current year. So that means when someone was written off, a, a debtor right who's written off, that means we saw that they were not going to pay us, so we wrote them off. So now if they come back, we no longer have them recorded as a debtor. So then when they bring that money, we can't now put it minus from our bad debts or put it as if we're being paid in our debtors control. Instead, we record income that is called bad debts recovered in our operating income. So then that debtor came back, we need to now have bad debts recovered and our other income recorded. Bad debt recovered. I don't know what's going on with this pen. Recovered. And that amount is equal to, what's this? 7,000. Okay. Then we continue. They're telling us now that in addition, the following was discovered. An EFT payment to a creditor for 7,200 was recorded. So this was actually recorded. And then they tell us that we were settling our account of 8,000. So that means we owed 8,000, but we only paid 7,200 to settle our account. Now, once it has your information is talking about settling the account and the amount paid versus the amount owed is different, just know there was a settlement discount. It should always trigger that to you that there was a settlement discount. If we were just paying in our account, and they didn't say we were settling our account, then no, don't think about it unless they say that it was settling an account. So in this case, you should trigger that the amount that we did not pay, that was a discount that was given to us. Does that make sense? So a discount was given to us of, we take the 8,000 minus the 7,200, and that gives you a discount of 800. Okay. So now we know we were given a discount. Let's continue. Yes, we were given a discount. What else do we need to know? We were given a discount of 800. Then the next part of the information says it was not processed by the bank as the account number was entered incorrectly by the business. So we made a payment thinking we are making it to our creditor, and then in our books we recorded that we have made a payment and we've gotten a discount. But in actual fact, that did not happen because we used the incorrect account number. So that means we did not get the discount and we have not actually settled our account. So we need to now minus the discount we thought we had received. Does that make sense? So we go to our discount received and minus the 800 that we had thought we received. Okay. Then what's the next part? A debtor who owed 9,600 was declared insolvent. The estate has paid 45 cents in the rand. The remainder must be written off as bad. No entries have been made for either transaction. Now, okay, this is gonna affect what's this? Gonna affect your debtors. It's gonna affect your bad debts because now we are writing them off. Yes. So, how do we do this? How do we calculate the amount that has been written off? They're saying 45 cents to the rand, meaning 45 cents to 1 rand. Now, what is that? 0.45 to 1 rand is being paid. So, the remaining amount, meaning 1 minus 0.5 45 or 0.45 is not being received. So that is 0.55. We're not going to get that amount of that total amount. So to get what that amount will be written off is, we take the 9,600 and we multiply that by the 0.55, and that will give us the bad debts that need to be written off. Okay, which is 5,280. Okay, did everyone get that? Do you want me to repeat it?
Yes, please, can you repeat this? I would like to set this for the record. I've never done that. So, like, whenever you're using this
Okay,
0.45 into 1, like, for me, I'm a little bit lost.
no problem. And let me repeat that. So the data owes us a total of 9,600. Then we are told 45 cents to the rand has been paid, meaning 0.45 times 9,600 has been paid. The remainder then, which is 1 minus 0.45, which is equal to 0.55, that is the bad debt. So 45% of this amount has been paid. 55% is that is the amount that will be written off. What when they say 45 cents to the rand, however, how many cents to the rand is, they're telling us that the 9,600 assume that it's equal to 1 rand and we only paid 0.5 of that. So that means you still owe 0.55. And if now you want the full amounts, you just take 9,600 times the cents or 9,600 times the 55 cents. Does that make sense? So the 45, this is how much was paid. And the 55%, this is how much we're writing off. And that is what we want for our statement of comprehensive income. So that will be 9,600 times 55%, which is equal to 5,280. Now, is that making sense?
Yes, I'm following now.
Okay. So we include that in our bid dates, 5,280. Then the next question says the provision for bad debts must be adjusted to 4% of the debtors. Now, for this one, we need to check, did anything happen to our debtors amount first? Was there any adjustment to our debtors before we can calculate that? So let's check. Mm, So our debtors, this calculation, like I said, it's affecting our debtors because this person has paid off an amount and has also an amount written off. The full 9,600 now is no longer part of our debtors. So we need to show that in our debtors amount by minusing the 9,600 in full. That was an adjustment to our debtors. And then let's just see. We have another detailed amount. We're just checking. Give me a minute. All right. What was I saying? Okay, so we have our debtors, and we need to check if there were any adjustments that affect the debtors calculation, the debtors balance, I mean. So we're starting off with 578,000, and we're minusing the 9,600 because some of it was paid and some of it was written off. So that's no longer part of our debtors. And then any other adjustment affecting our debtors. And then I don't think there's any other adjustment. I don't see any other adjustment that affects our debtors amount. So what you do there now, your new debtors amount after you've minus the 9,600 should be 578,000 minus 9,600, and that should give you 568,400. Okay, is everyone with me up until that point? Yes. Let me just ask, does everyone understand first why I'm subtracting the 9,600?
Nope, me, I'm not following.
Okay, let's go back to the 9,600. 9,600 was the data. We were told they paid the 45 cents to the rand, and then the 55 cents was written off. Now, when someone pays the amount they owe us, what does it do to our debtors control? It decreases our debtors control. So let me just look for the balance here, 578,000. So we're starting off with 578,000, and we need to minus the amount that was paid, and that amount is equal to 9,600 times 45%. And that gives us 4,320. So we minus the 4,320, right? Then we were told 55 cents was written off. What to the rand? What does it mean by written off? We are no longer we are writing off this data, meaning we are removing them as a data because we don't expect that they will pay us. They've been declared insolvent, they're broke, they will not be paying us. So we can't have our assets, that amount included in our assets as if we're going to get the money. So that's why we minus the 5,280 as well. And as we know, that's equal to the 9,000. If we add these two together, that's equal to the 9,600. So that's why we are subtracting the 9,600 because of the amount of it that was paid and the amount of it that was written off. They're no longer part of our debtors control. Does that make sense? Octavia, are you good with it now?
Yes, I'm following.
Okay. So then that gives us a new balance of 568,400. Now that we have the new balance now, and we're told the provision for bad debts must be adjusted to 4% of our debtors. Our debtors is the 568,400, and we need to calculate what 4% of that is. So 4% of that is equal to 22,736, and that is the provision for bad debts, the new balance for our provision for bad debts. Now, why is this relevant for our statement of comprehensive income? We need to compare the new balance of our provision for bad debts to the old balance. So let's see here. Provision for bad debts, there it is, 23,500. Now it's 22,736. So what has happened to our provision for bad debts? It has decreased. Now let me first go back and explain what is provision for bad debts. Provision for bad debts is when you are now looking at 100% of your debts. And because of the history, because of the knowledge you have, you know that you're not going to be getting back that 100%. So what you do then is then you assume, according to how things are going, okay, that 5% you won't be getting back, or 4% you won't be getting back from what people owe you. So then you don't know exactly that you won't be getting that money, but you're making an allowance, or you are just providing for that in case someone doesn't pay me back because it usually happens. That's provision for bad debt. So it decreases your debtor's control. Now, what has happened to it? Before, we were decreasing our debtor's control by 23,500, but now we're decreasing by 22,736. So what does that mean? We are decreasing by less. We are now expecting more of our debtor's control, and that is a gain. So if your provision for bad debt decreases, it's a good thing because that means you are minusing the debtor's control by a smaller amount. If it increases, that's a bad thing for you because you're expecting to lose even more money. So then you put that in your operating expenses. Did that make sense? If I didn't, but you guys didn't understand something, again, like you can always ask me to repeat. Just tell me. Okay, is everyone good? I don't know if I'm cut off or something, but I can't hear anything. Hey guys, just type in the chat if you are
Yes,
good.
I'm here. I'm
Oh,
here.
okay. Okay, so everyone understood that. So we're just going to take provision for bad debts adjustment to our income. Provision for bad debts adjustment. That amount will be the 23,500 minus the 22,736, which will give you 764. That's in your provision for bad debts adjustment. And this is your new closing balance for provision for bad debts. Okay, let's continue. A loan repayment of 24,000 is due on the 31st of May 2020. Now, loan, that's a liability. So that would be part of your trade and other payables information. Just we'll ignore it for now, for this SCI, for the SCI. It's not relevant. Now, after that, they tell us after all the adjustments, an amount of 14,900 is still owing to SARS for the company tax. Okay, so they're telling us that after everything, after we paid SARS and this and that, we still owe them 14,900. They're telling us we still owe them. They're not saying that's the tax expense for the year. They're saying after everything that has been done, we still owe them the 14,900. So then we need to look at our balance before, and we also need to look any other information that they have given us. Okay. So let's see here. 14,900. Okay. We have here 586,300, and in our opening balances, they didn't say we owe anything or we have overpaid anything, so we can ignore that. Now, the SARS 586,300 debit, what does it represent? So I don't know if you guys have done it or it has been properly explained to you. It should have been done when you were doing companies. During the year, what you do is you make provisional payments of tax, meaning you estimate what your tax amount will be and you pay. Then at the end of the year, that's when you really know what the amount of tax is. So these, the debit, the SARS income tax here that has been represented in your balance sheet on the 28th of February, that is a debit balance, that is representing your provisional payments. Question before I continue? Yeah. So that's your provisional payment, meaning that's what you assumed that you owed for such you owe to SARS in the current year, and you pay that amount. But now they're saying you paid that amount and you still owe 14,000. What's this? 14,900, meaning your tax for that year then is the 58,586,300 plus the 14,000 that you still owe. So does everyone get that? Let me just make a small example. Let's say you owe me whatever amount, we don't know what the amount is, and then you pay me 100 rand, and then I tell you you still owe me 50 rand. So then, if you pay me 100 and you still owe me 50 rand, that means the total amount that you owed me was 150. So that's the same thing there. Our provisional payments were 586,300, but we still owe 14,900. So that's why we're adding together to get our total tax expense. Does that make sense? Okay. Everyone good? Okay, then let me continue. So that'll be your taxation for the year. And guys, it's important. If this SARS income tax was here in our opening balances, that would not mean that's your provisional payments. That would just mean it's your SARS from last year, this balance. So there's a difference between that. Right. So this should give you 601 200. And that's your tax for the year. And then I don't see any, I think we're done with the adjustments, with the tax adjustment. Yes. So those are all our adjustments. So now, from this point, what you would have to do is just to check if everything has been recorded. Now, let's start with sales. Sales, we recorded the adjustment, but remember, sales is equal to your sales amount minus your debtors allowances. So we need to minus the 420,000. Okay, so everything has now been recorded. So now what you do, I'm not going to do it here, but I'll just make sure to paste what's this, the fully done statement at the end. But what you do then after this is just to total up your amounts. And if it says do not calculate, then do not calculate. But everything else just total up, and then you would be done with your SCI. And there's nothing else anywhere else to calculate. Okay. Now, any questions before we close off this lesson? And then, okay, before I continue, before I give you guys a chance. So with interest expense, they gave you 23,040, but you would have to check as well. So the loan amount was 288,000 and interest is at 8% per annum. So just make sure you do check that they've given you the full amount. So how would you do that? Take the 288,000 and multiply it by the 8%. And that should give you 23,040, which is the, what's this? 23,040, which is the interest expense that they have given you here. But you only check just using the balance if there are no other adjustments to the loan in the current year that you need to, what's this? That you need to adjust for. This adjustment is for next year. As you can see, 31st May 2023. So you can ignore it for the SCI calculation. Not ignore it for all time. It is important, but not for the SCI, the interest expense calculation. Yeah, I think I'm done with 2.1. Does anyone have a question? Is everyone good? Nothing you want me to repeat before we close it? Can you guys still hear me?
Yes, we can.
Okay, so nothing. No questions.
So I'd like to ask on the SARS income tax,
Mm-hmm.
when it's a credit balance, which means that SARS owes the business money.
No, if it's a debit balance, SARS owes us money. But if it's a credit balance, we owe SARS. Now, this debit that was given here, the reason why it was a provisional payment is because it's not a closing balance or an opening balance. It's just how much has been paid to us in this moment. Now, as you can see, if you look here, I did note at the beginning of the year that these are balances at the beginning of the year. And as you can see, they didn't say, they didn't mention anything regarding SARS. So our SARS balance there was zero. Are you okay? Is that making sense? Then once we got to the
Yes.
adjustment, they told us that after all adjustments, an amount of 14,900 is still owing to SARS, meaning this is a SARS credit balance at the end of the year. So we can't have the 14,900 as our closing balance and the amount in the trial balance also as our closing balance. So that means if this is not the opening or the closing balance, then it is representing our provisional payments, meaning the payments we made to SARS when we're still assuming this is how much we owed. Does that make sense?
Okay, yes, I see.
Yes, but in the information, you need to look where have they put the information. So if it was an opening balance, that was a credit balance, and it's telling you that that is the amount you owe to SARS. If it's a debit balance, whether it's opening or closing, then that's telling you that's how much you owe to SARS. So credit, you owe SARS. Debit, SARS owes you. Sorry. Yes, SARS owes you. So that's a refund. But if it's a credit, that's the amount you owe, looking at your
Okay.
balances. But if it's just in your trial balance and it's not a closing or opening balance, and it will all usually be a debit, then those are your provisional payments.
Okay, that makes sense.
Any other questions?